Okay, this is a part three of my video on reviewing the project finance analysis and project finance case studies. And the subject of this video will be PPP projects. Again, I said earlier that PPP projects can just about be anything. Now, give me a caveat. I need a caveat. Somebody gave me thumbs down, and it broke my heart already on this video. Please, I don't have anything that fantastic to say about this or anything else. I'm going to go through uh, uh, some issues of value for money. I'm going to discuss some of my relatively radical ideas about IRRs and what they really need to be and whether you need an IRR on an O&M contract and things like that, or risk premium. And we'll go through a case study for a PPP project in Africa. So that's a little bit of an introduction. Turn off the video if you want, okay? So uh, let me get ready here. Nervous. I'm going to, here's what I already talked about. So this is a slide somebody kind of gave me after I gave him a model. I don't know if it was a good trade or not. You could have total public projects that are corporatization. They just have a civil works contract, and then you could have BOT, um, DB, oh shit, or full divestiture, full privatizations, okay? And here's an example of what a PPP project would be, where the developer finances the construction and it gets all the capital, gets the revenue. This is for a housing project, but it doesn't take on the operation and maintenance because it really wouldn't be very efficient to do that. So I decided to my the people who were taking the course wanted a project on social infrastructure in Africa, and I looked around on the internet, and that's all I'm doing. But this project seemed kind of interesting. It's a hospital. It replaced an old hospital, and in this project, the O&M and the service, really the doctors, were part of the project. Okay, and in this, there was not much there, was it? Oh yeah, here I said the doctors do that, and you could have alternative structures, of course. And the thing I'll talk about really more than anything else is not offering the services, but where you where you build and finance the facility and maintain the hospital more than if you offer the doctors and so forth. Okay, and this was kind of the interesting part, and this is where I'd start. And uh, uh, on the internet, I found this little table, which for me told me a lot of the story. And the first question about this is the financing. And in this case, there was some. The first thing I noticed, oh, look at that. The equity holders receive a 25.2% IRR. And I'm going to stop here. I'm going to stop here and I'm going to, of course, come back to this. Now, this was really stupid for me to get all out of sorts about this because the equity offered very, very little of the financing. In fact, the bigger deal was this junior debt, which had 13.1% cost or interest rate, which is the same as the IRR. The senior debt was not cheap at all. And we don't know what the government did some financing. So this little uses of funds was a nice little thing. And uh, what I did here was just said, okay, well, let's do a little exercise on this. And when we do this exercise, let's just put in, and let's just be very, very simple about it. Let's just say that the government's interest rate was 4%, 8%, excuse me, and the commercial and the junior debt was this. So we can do a little bit of case study. And then I didn't know the maturity. We really need to know the maturity. I pretended that the junior debt was a little bit longer. So the first thing we should do is, again, learn. This is too embarrassing to say, but use the PMT function all the time when you're just doing a little kind of example to figure out what's going on. And what you do here is then you can get, okay, if it was a flat payment, if the payment was completely flat, that's what it would be. Of course, it might not have been flat. And then I can copy this to these ones. So this gives me the total payment, the equity we don't put. And now let's understand kind of what the equity IRR. Let's see if we can replicate the equity IRR. And once we've done this, I put a little bit of a premium for the EPC contract because I want to discuss when we talk about value of money, value for money. One of the things is what's the premium we give? We give some kind of profit to the EPC contractors, so they'll take the risk. That's perfectly legitimate. They're not sure if they're signing a fixed price contract, they have to take the risks that they'll have trouble mobilizing their employees, they'll make some mistakes, they'll have to redo some stuff. Oh, that's fine. And then we put a contract period and that acceptable return we won't use. So let's see what kind of equity IRR. And I hope what I did is I fudged this around. And so all we do is, let me uh, do this thing. Okay, and up, I put a lot of rows in there. Okay, I was just using something else. Excuse me. Okay, so we can kind of see what's going on, just a little bit more of what our assumptions are and where some of our numbers came from. These must have came from where I just took the hospital inputs. That's why they're a little bit of a red number, okay? And then, so now we can put in up here, this is what I really wanted to do, we can put in our payment and press shift down. Too much Excel here, I wasn't supposed to do any much Excel, but we're just going to illustrate kind of how these projects works, and we better do a little bit of something like this where we only limit this one to 20 years. So we take this one is less than or equal to the 20, and we multiply that one times this number. So what we do is we get our cash flow from something like an availability payment that we'll get into later. I'm going to, in this session, go through an example of an availability payment contract. It's essentially a fixed contract. It could inflate or it could not inflate, and then we'd have to restructure our debt differently. And so this one went all the way to the 20-year period. And I suppose I should do the same sort of thing here. I'm really bad at this. Excuse me. Everybody else would really yell at me for not doing this right, where I put the little things in there. So we can Control D. We can copy this down and copy this across, and now we have different tenors. I hope so that they last different amounts of time, and excuse me for this, then net cash flow would be we'd subtract the rest of them. I should, excuse me, it's here. Okay, so that's our little exercise. I better give you this exercise file in case anybody want to be idiotic enough to do this. And then what I try to explain, this is like kind of your life where you get no money, you're struggling all the time. And then unlike me, some people want to get a little bit of extra money when they finally almost hit the end and live a good life, whatever. And then now what you do is on the for the equity cash flow, you just say, okay, well, what's the total amount I'm paying now? What we haven't done really is uh, uh, in, said, well, what's our equity cash flow if we consider the profit we're trying to make on our EPC contract? Okay, whoops. And I better take that call. Okay. So we have the, I'm picking up here. I gotta remember exactly where I was. So we have the total debt financing, and uh, um, we have the total capital expenditure of the project, which I assumed had a profit of 20% included in it. And the equity cash flow, all right, I apologize for that. I just did a little goal seek to make sure it exactly equals. So there's our financing, and then we can compute our equity IRR as just in this case. Again, it's no fancy XIR or anything else, but it's the amount we take out of our pocket relative to the amount we put into our pocket, and the IRR is the difference, okay? Not a big deal, and I hope that's similar to what we had in the inputs. It's 25.22, okay, 25.36. Now, just to get started, again, uh, you don't have to be some fancy modeler to understand how these things fundamentally work. We had some different financing. We started with some cash flow on the top. We had a project IRR of 11.38, and we have an equity IRR of 25.36, which should make the equity holders really, really happy. Okay, but it's highly levered. It's almost not it's almost meaningless. Now I'm going to save this file just for a second. If all of these could be financed at 8%, okay? Oops. I couldn't do this. Just a minute. Sorry. If they would have been financed at 8%, and we didn't have to put any of this EPC profit in here, okay, and we don't really need any equity, but we'll put the equity in at 8% or something like that as well. Then we could have, uh, uh, again, let's just do it like this. Okay, so let's put a target NPV at target IRR. I'm doing perhaps a little bit too much Excel. We'll okay, and we'll just take that, and then we'll do a little bit of a goal seek where we say what happens if we set that to 0 and we see just how low the capacity charge. Remember, right now the amount we have to charge all the people who are going to use our project is 149.8. Okay, and if we do that, we can change it dramatically. If we don't have to charge an EPC profit, and if we can just do the financing less, let's do it this way. Let's put an EPC profit in and do a little bit of what if analysis on the goal seek and set the, again, sorry, set this to 0. Remember, our initial one was 150. So this, I get too fancy with all the Excel all the time. Then just by having the lower financing, we get down from 149 to 118. So the real question is, why does the government sign an EPC contract with this premium in it? And why would you pay a higher financing cost? And that's where the value for money comes in. But before we do that, I just am going to go backwards just a little bit. And excuse me, I got off track a little bit on our solar. I hope the solar project will be easier for me to kind of explain. We're going to go through in the next session a whole solar analysis. All right, and come on. Okay, we'll talk. Just review the IRR. I can't remember exactly what I told you about the IRR. Okay, and all I want to say is that whenever you look at any stock price analysis, okay, and I'm just going to have to do this for the umpteenth time, and I'm sorry about this, but whenever I try to explain this IRR, I think some people get a little bit pissed off at me, and I try to tell you about stock prices, okay, and I open this file called Comprehensive Stock Price Analysis, and then I try to tell people about the IRRs. Now, when I hear about IRRs these days, maybe I'm completely out of date or something else. Right now, I compared in real terms, in real US terms, the DAX is a little bit distorted because I'd have to deflate it and adjust it for the euro exchange rate. Since 1987, 1990 rather, 1990, you would have earned about 5% real on the US stock market, and about 4%, 4.7, and you can see right here, this is the effect of the, I think the effect of the tax law, just about exactly what it would be. There's the effect of the virus and all, or the pandemic and all that. Now, if you go way back further, we can't go backwards for the DAX. If we go way back further and calculate that, and this is adjusted for inflation, you notice the DAX is not there, so let's unclick that one. The real rate of return on the stock market has been about 3%. So lately it's been a little more, and if we wanted to then also compute the premium you make on stocks, and for some crazy reason, people use a 10-year bond rate, so I'm going to put the 10-year interest rate here, and that one I only have it since 1953, so let's compare the two since 1953, and we're taking inflation out of them both. And there has been, the real rate on interest has not always been 0, okay? And I have to recalculate this. And so the real rate on stocks has been 4%, on 10-year bonds, 2% to take account of the inflation risk that you really have to take with bonds, and just a risk, a real rate that's not equal to 0. And then if we see when the stock started really going up in the when Bill Clinton was kind of president, of the US, uh, and you can attribute this to whatever, then the stock market indeed has had a higher return, but still the difference between this and this, 5 minus 2 is about 3, maybe 3, a little bit above 3% for the equity market risk premium. This is the kind of the key. I'm going to, well, I'll leave the bonds there, but then let's look at Apple and let's look at Amazon, the two kind of remarkable stocks. And let's see. Apple started in 1980. So if we look at uh, actually, it's got Amazon went way down and then way up. And even though Amazon had, they put over the long period of time, they have a beta, and the IRR on Apple was 19%, the IRR on Amazon, which really we should have, Amazon, we should have started in 97. The, oops, recalculate that. And here's the whole point about this, and I got to stop soon. Come on. So here's the rate of return you would have made on the stock market. Here's the return you would have made on Apple. Incredibly good return. The highest kind of in the country that, or in the world. They had a kind of decline here. Amazon even had a little decline recently. I'm sure you know much more than me. That's how much you would have made. On Amazon, you would have lost a little and then made, and you would have made this 1.25. The reason I'm telling you this is when we're going through what kind of IRR you really need to make on a stock, here's Amazon, by earning a 30% IRR and then reinvesting his money. That IRR includes a whole lot of reinvestment. That's what Yahoo.Finance assumes, that if there's ever a dividend, it's reinvested. But if there's no dividend, you just take all your money, put it back in the company, and then it keeps growing. He paid 38 billion. That's what a 38% IRR means. Now, if there's absolutely no way you can use this MIRR, but let me show you. If you are assuming, if in your project finance model, and you should compute a debt IRR, equity IRR, project IRR, all I can say is this for now. Project IRR has the IRR with no financing, no interest during construction depreciation, for example. No fees, no nothing. Pure non-financing, as if you put in 100% equity financing in your model. My hero, Merton Miller, said that's the way to evaluate anything, and indeed it's pretty good. If that IRR is really high, you should question it, blah, blah, blah. I've probably talked about it too much already. Equity IRR is when I see models, when I see projects, sometimes they don't compute anything else other than equity IRR. Not sometimes, a lot. Okay, and here's some examples of some IRRs. This is a project, I think, in the Caribbean. Here's a project where they were expecting a nominal IRR of 23%. This is in Africa. This is the Lekki Expressway, I think. And I've seen other really high ones. Now, if you're going to earn an IRR, let me just prove to you what an IRR really is. Maybe this is totally unremarkable, and I need some real whatever you call that thumbs down. So in this case, I've got a IRR of 15%. Okay, and I computed the NPV business. If we want to see what this IRR of 15% really means, and we've got a 20-year life, what we can do is make a little opening balance and a closing balance. And we can take that opening balance and multiply it by our rate of return. That's the reinvestment issue. So the way the IRR works is it assumes you make a reinvestment. Now, this MIRR is supposed to solve that. I guess I'll do that for now. And then you get your dividends. And you're going to take those dividends and reinvest those, okay? So all I'm going to do now is copy this across. And what did I do there? Okay, maybe I have, because I opened this silly stock price file, when you open this, it puts the calculation to manual. That's why I kept on having to do that little bit of a recalculation, okay? And I've been messing around with that file to get it just right. And so what happens is eventually it finishes here, okay? But we want to only compute this reinvestment over the period of the life of the project. So if we go to the end, by the time we're finished, this amount you get to, let's pretend you had some fake little bank account that gives you that ridiculous 15% interest rate. If you could do that by the end of the project, you'd get 22,040. I just put that over here. Okay, I don't know exactly if I could have done a lookup, whatever. And then you only invested 1,200. That's a pretty darn good thing, isn't it? And then if you take this number divided by this, and you say we have a life of 20, then you can take this number and raise it to the power of 1 divided by the life and subtract 1, and you get exactly the same thing. We just proved what an IRR is. And just to show you the dramatic effects of a different IRR in kind of real money terms. Let's say we have a miserable old IRR and we make something like we only make that's a little bit too low. Okay, let's make something like 4%. Then our ending value is 2,700. But if we make 120, suddenly our ending value is, so what was that last one I had? 90. If I increase and that gave us a 4% IRR. If we get a 7% IRR, we get 5,000. The whole growth rate thing works. But if we can start to get a whole lot, then the amount of money we actually get is enormous. Now, if you would put MIRR here, and you'd have to put a discount rate, and even if we put something like a low discount rate, here's what happens. You take the values, you take the cash flows, and then you put a comma, 2 commas in, and you put the discount rate in there. And basically what it gives you is the discount rate. What good is that? What a waste of, you're trying to measure performance. That MIRR certainly does not help. So that's just a little bit of background on the IRR before we get into a couple of these other issues. And the reason that's kind of important is starting in this value for money. And the way the value for money, the reason is it affects if investors say they need a really high cost of capital, that's going to really have a dramatic effect on the price the government has to pay for a project. So in this case, I'm going to go back. You remember what I did as I tried to put that 20% EPC profit in there, and I tried to put the different cost of capital in. The question is, should this be a government project or should it be a private project? And the general idea is here, the winning bidder, if you have a tough bid, they're going to bid down that IRR. They're going to bid it to a low cost, okay? And here's what I did. But the problem is, you know, you got the off-taker paying. So I have that as a green one. This is an ancient slide. But then you got to pay the developer a profit. He deserves one because he or she, they took all the risk. Then the IRR, that's a profit. The lender gets a margin. They get a profit. The O&M company gets a profit because they're taking some O&M risk, and the EPC company gets a profit. And by the time you've paid 1, 2, 3, 4, 5, 6, all these profits, why don't you just make the thing a government project? Please don't get mad at me. I'm not saying that. Okay, so when you try this value for money, it's understandable that you'd want to try this. You have to say, okay, let's make this PSC. I never knew what that was before. Public Service Comparator. So you might even get a bid on some kind of projects. And then you have the PPP project, and you try to take the difference. And you have to consider the whole lifetime of the investment, of course. You don't just consider the cost of the project up front, because you're going to, if it's a PPP, at least we're going to assume that we're going to finance it, and we're going to and also we're going to, sorry, I just had to check if I still had the stupid little the video still going. Oh, excuse me for that. Okay. And we have to pay all these costs. Okay. My friend from Ghana gave me this. Okay. And so here's the public service comparator. You hire an engineering company, you hire a construction contract, you might have a tender project. And then there's this famous thing called optimism bias, that everybody, when they bid at a low cost, and then they're going to come back to you. Just this happened to me. Oh my God. I had to try to fix my father's house, and I made a contract with my son's father-in-law, and I didn't make a fixed price contract. And before and he told me it would cost, you know, give me a number, let's say, whatever. And before I let him use my credit card, which I thought was okay, he's family. And the credit card was twice as much as he had quoted. Oh my God. I want a fixed price contract. What an idiot I was to not do that. So but there's optimism bias. So if you don't have a fixed price, if not, somebody's not taking the risk, that's the real value of having a private company do this. And in addition, they might be a whole lot more efficient. These people might be more efficient in doing it. These might be more efficient. I don't know about these really, but these might give you a real fair IRR because they're bidding it down. These people will, if they're in it, they'll be part of the bidding process, and they'll all kind of do it real well. Okay, so there are all these kind of things that affect the life cycle. I'm going to give you the slides. You know, I don't know. You know, you can have more efficiency in design and variation and all that, and perhaps the contractor will coordinate the O&M better than you would if you had all separate parties and all that. And then you come up to this one, and you come up. This is the PSC. This is the government. They have some estimated cost, but the big one is they have some cost overruns at both places. And if you have a PPP, you have a payment based on quantity, availability, and a payment based on usage. I love the fact that they show this separately. Of course, I didn't do that. I took that from somebody else. Okay, and then I should put who I took it from to give them credit. And then you have life cycle. So this is the kind of benefits you should be able to get. This O&M efficiencies and economies of scale, best if it's one contractor, innovation in construction. The biggest one is this risk allocation, and that's the hardest one, and that's what I consider. Oh God, I don't want to get myself in trouble, but it's a little bit of whatever. I'm not going to get myself in trouble by getting people all pissed off at me or something. And this is so you have this PPP bid and this PSC. Now, if there wasn't this transferable risk thing here, retained risk, that's the risk that's going to always be there. If there wasn't this transferable risk from the optimism bias, I think this would be low. And then there's some competitive neutrality because you got to take out the taxes that the private company would pay and all that kind of stuff. All right, and then you get this kind of thing. Okay, you have a base cost. The financing costs are more from for the private company. We saw that in our little model. Other costs are more. Every costs are more until we get to this retained risks. This should be. I don't think this should be transferable risks really in this thing. The retained risk could be the same, but these are the risks that the government takes, and these are the risks that the government pays for in the PPP scenario. It's kind of maybe I'm going through this too much, and then the question is how to make that assessment, understanding that it's a very real issue, and you have to sit there and identify all the risks and see how much the risk will really cost you, and then do some kind of probability calculation, and you can get the value of the risk. Here's some examples of that. Okay, and here's some more examples. But again, the big difference in this one, there's a higher financing cost, and the risk is the big difference. It's almost the same. Maybe they just took it from the same kind of chart. It's I think for me, having to go through this again is worth it to just step back and really think about the theory. And it's true, there is. And I've got when I'm going to put this file on the website, you can go and read, somebody who said, okay, how you compare the projects and how you compare this competitive neutrality and take account of the taxes being the same and all that. All right, okay, so you've done this, you've proved that the PPP is better, and now let's go through and see how some of the risks are allocated. So for this course, people wanted me to kind of go through some contracts. And I think it's useful perhaps to go through and see how some of these payments worked. I went through it for an electricity company, or electricity project rather, and now we can see how these payments work. And what there is there's a payment, and then just like it was almost exactly the same as that electricity example, there's some indices. And then you have some subtractions for three things, which is kind of interesting. Unavailability. This is this issue I mentioned the last time about the lights not working and all that stuff. Performance, if you're not as efficient as you should be. We talked about that in the context of a heat rate or efficiency. And then I guess if you don't do some reporting requirements. So this is our same project in Lesotho, and there's lights out. Oh no, they might better have a deduction for that. The floor looks pretty clean now, so we shouldn't have a deduction for that. And you have to go through and kind of figure all this stuff out. So what a pain, what a kind of pain there is. So you go through all these criteria, and you have a unavailability notice if your floor is not clean and all of this stuff. And what else do I want to say? You define how this thing will be escalated, and then you have your charge. And your charge is a monthly charge that could be escalated, and that would depend on the currency and everything else. And then you might have a notice that this project is unavailable. And how does this notice work? well, in this case, it was a school, and somebody, the head teacher and all of this, had to give you a notice, and then the notice defines exactly how this notice works and all this. I thought it was fascinating to read this. Now, I'm joking, but it really is kind of good to see just one time how these things really work, and then you have all these deductions, and whereas you read through these formulas, this is an area failure deduction, and DP1 is the how long it's been out for, and this ratchet factor that says how much are we going to reduce. This is 1.5, so that means our availability charge could be reduced by 1.5 for this ratchet factor. And this you can have, if it's a really critical thing like the lights in the surgery room or something, some kind of deduction for that. And then this is just the charge itself, and we have an unavailability factor. Okay, I haven't really gone through that much before. And then this was, I thought this was worth putting. They go through point by point. What is the, where do you get this unavailability from? If it's a fire alarm system, you can reach illumination at lux levels. That's our lighting example. Safe hot water supply, permanent structures, and then you have to be careful that they all exist, and more and more. Okay, enough of that. And then, okay, I think it's okay. And then, so the next subject I'm going to address just a little bit is how all these contracts are actually back to back. I discussed this last time in the context of a PPA, and this is still a PPA, where you have one contract, and in this case, clearly the O&M contract, the O&M contractor has to have the responsibility for all of these things not being available. If you didn't have it back to back, the incentives would be all wrong, and you couldn't get the types of financing. The bank would be very reluctant. And the O&M contractor, just like when you think about a bank for a minute, a bank has to put capital up when it makes a loan. This is part of Basel, this wonderful city in Switzerland with the beautiful fountains and the Rhine River, and there's some just little villages outside that are wonderful. Where my no, Basel 2 and Basel 3 and Basel 4. They define how much capital you have to put up because you're going to be taking some risks. And the same sort of thing you could imagine. The O&M contractor has to put up some capital, and then they have to figure out kind of what's the likely chance that there'll be some unavailability here that will transfer down to them. That's the big issue. And the EPC contractor, there could be, of course, some of the same kind of liquidated damages penalties from from the concession agreement, and that would have to be passed on to the contractor. Okay, and here I just have some electricity stuff, but here you can almost see how this stuff is back to back. Whereas escalation will refer to the PPA, penalties will refer to the PPA, although the penalties never here are exactly one for one. There's a maximum penalty, and it discusses this. And here's some liquidated damage contracts. Again, what I did in this on if you send me a little email or put my thing in there, I tried to put some examples of some of these agreements. Okay, and at first I said, "Oh God, why would anybody want to do this and look through some of these kind of agreements when I could get a hold of them?" But it might be worth it. Okay, and this then shows you some more O&M penalties, and if it's below that, you uh, 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 it's okay, and then you get some bonuses as well as penalties, and you can see how they're exactly kind of back to back, uh, not perfectly. Again, I use a example of a heat rate in here, and there's an incentive if you do better, and if there's higher, it's capped. And here's a enough. I do have some examples of some of these things, and they're not nearly, of course, as straightforward as I'm making them sound out to be. There was a wonderful little example where you just get, oh man, in the test, in the testing phase, right when you're doing the commercial operation date, everything in the contract looks perfectly, but you just turn some knobs and you just get it so that heat rate just matches your kind of maximum amount. You just pass the test, and then you hand it over after the EPC is finished, and you never can get that heat rate again. And then you start fighting forever. And it's a big, that just a little bit of a difference in the efficiency or a little bit of a difference in some of these things makes an enormous difference over the lifetime of a contract. Okay, I'm skipping this one. And then I'm discussing some credit ratios, but I'll do that again. Yeah, no, I'll do that right now. I think uh, when we talk about debt, why is it? I'm just reading my slides. For me, I told you that I am so disappointed in politics and governments. But you know what? When I try to think of heroes, it's impossible to think of a hero in finance. I used to think, oh God, I used to think all these people were so great. I used to believe in the capital asset pricing model. Oh God, it makes me throw up now. I used to believe in this option pricing model that was such an elegant kind of thing, and we've all seen that it's just, I don't know, it's no such thing as normal distributions, and it was just a mathematical kind of thing. And then I used to believe in pharma and efficient markets, and pharma's a pretty interesting guy, but nah. And Modigliani and Miller, that's the one I still think is pretty good. But in project finance, it's a waste. Because in project finance, getting debt is like getting your passport stamped. If you can't get debt, you can't get the project approved. And I go through this example way too many. I say there's one person who makes this most beautiful PowerPoint slide you could ever say, has the betas, has the equity market risk premium, has every formula defined. Oh my gosh, it's beautiful. And she presents it to the CEO, and the CEO says, oh, very nice presentation. Yes. And the next one, somebody else comes in for the next presentation on another project. And I'll make it a he this time. Sorry, don't get mad at me because I'm thinking about a back pocket. No, we'll make it a she. She's got pants on, okay? And she's late for the meeting. Oh, no. It's not good to be late. But she comes in late, and then she has no PowerPoint slides, no pictures, no nothing, except she has a little bit of paper that's crumpled up that says the bank is going to give me 90, 80%, 70, 80% of the project. And guess what? The bank doesn't give a crap about you, Mr. CEO, or anybody else. The bank wants its money to be paid. If they don't get their money paid, that's pretty bad. And so you think about that. You've got somebody from outside of the company verifying your project. What a fascinating and important thing that is. That's project finance theory. That's why we can't kind of use Modigliani and Miller, and debt is irrelevant in this one. So when we do this, I just want to talk about the DSCR. When I talk about the DSCR, I talk about an alarm clock, or in this case, I compare going If you have to catch a plane, I asked them, and you had to go from Tahrir Square to the airport, and it's 5 o'clock at night. It says up here on the Google Maps that it's only going to be typically 22 to 40 minutes. And then I asked, would you leave 22 minutes if you have to go from here to here? And it was around 1,700 hours or something. And they said, are you crazy? You wouldn't use this. You'd have to add a buffer of an hour. Or what happens if you had to cross the bridge? We might have to add a buffer of 2 hours. That buffer, that's the DSCR. That's what the DSCR is. That's how you measure risk in for a bank, not with all of these value at risk, P probability of default. You see how much extra space do we have to have? And this extra space, this is the DSCR. This is the cash flow on the top, and this is the debt service on the bottom, and this is a tail that gives you an extra amount. This buffer, this DSCR protection says we can go down by X amount before we're not going to default. So here's the example of how you really think about the DSCR. Let's say the cash flow is 150, and the debt service is 100, then the DSCR is 1.5. It's just how much cash flow do we have compared to debt service, and our buffer is 50. You could say I have a 50% buffer, 50 divided by 100, but that would be idiotic. It's 50 divided by 150 to tell you how much can the cash flow go down before I default, how much before I cannot pay the debt. And that's why it's a buffer. And if we would take 1.5 minus 1 gives me 0.5, and divide that by the DSCR of 1.5, I get 33%, which is 50 divided by 150. That's how you use the DSCR or the LLCR or the PLCR. It's a ratio of a buffer. And that's a pretty good way to look at things. Okay, and here I just say, well, you could kind of go the other way. If you know, let's say the interest rate is 0, okay? A crazy assumption. And you know the DSCR is again 1.5 and the cash flow is 50. Then we have enough to repay 100 of debt. And let's say we repay it for 10 years, no interest. The debt service is interest plus repayment. There's no interest. So debt service is repayment. Repayment adds up to the amount of the debt. So we get 1,000. So it gives you this basic formula that the DSCR defines the amount of the debt you have. Okay, but let's say the same project with 0 interest rate. It's really the NPV. We have to just change this to the NPV to get the amount of the debt. But let's say we have the project cost only 800, but we're allowing 1,000 debt. That means the company gets to put 200 in its pocket right away. If the SPV does really well, everybody's happy. But if it does badly, the bank kind of gets screwed, and the company got to put 200 in its pocket immediately. It has no skin in the game. It has no skin in the game. So when we're really sizing debt and looking at debt, we have to look at both of these things. All right, and then we could talk about LLCR and PLCR. Actually, I think PLCR is really a fascinating, important one. PLCR says instead of, the NPV of the debt, of the debt service is the same as the amount of the loan. I should have really said that here. Now I realize I probably needed a little bit of an extra slide for that. But if we take at the interest rate on the debt, if we take the present value of all the cash flow over the life of the loan and realize that the present value of the debt service is the same as the debt, this ratio called PLCR, it measures what happens if we go down and push this down and down and down, and then in present value terms, we push it down and we're going to have a default and we're going to restructure our debt and we're going to use this extra tail at the end to restructure the debt. But eventually, if this is so low that we have a default, we might not be able to restructure it. And that's really what the PLCR does. And it's an effective, interesting ratio, especially in times of pandemics and everything else. LLCR. Let me take a rest. LLCR is the same thing, but it just says take the present value of the loan life. So in this case, it's kind of boring because the LLCR and the PLCR will be exactly the same. By this, this is going up and down like a solar project or something. And the DSCR stays the same. So the LLCR measures the present value of this divided by the present value of that, but we stop at the red thing, and it says how much can this go down versus this over the whole life of the loan, not over the whole life of the project that includes the tail. So the PLCR includes the tail, the LLCR does not. Okay. And then corporate finance doesn't use the DSCR because really we don't tailor the repayment against the cash flow like you do in these kind of things where you sculpt the debt. You don't even have to sculpt the debt. So in project finance, we use all of these, and we use a debt to capital measure to measure how much skin you have in the game. Because remember, if you're investing 800 and you get 200 back, you don't care if the project does badly. You love it when it does well. You'll keep it, but otherwise you'll give the keys to the bank. Okay, corporate finance you look at very different kind of ratios. Maybe you look at something a little bit analogous to DSCR, which is just EBIT to interest, and then you can look at funds from operations, which is EBITDA minus taxes and minus interest, or you can look at EBIT, which doesn't have, it says that we need the DA to cover our CapEx. So there's they're very crude compared to the precise DSCRs that we can really interpret. Or you can look at how much time does it take to repay the debt. Now, the reason I'm doing that is at the end of this third, are we on session 3? Yeah, I think so. We're going to talk about some airports, and we can talk about other ratios, and I'm going to skip over these just a minute and go to our airport case study. So our airport looks very, very different really than some of our other projects. I think this is an airport in Senegal, and we should remember some projects take price risk. The first project I introduced to you was this project for the LNG, the Ras Laffan project in Qatar. Some projects, I said, like these availability projects that you think are so safe, they're really transferring all the risk to make it political risk. And then there's another saying in project finance. I should have said this. My old friend Kamiar, oh, he was wonderful. He started me on this whole thing. Oh, he died. He's great. He said, if you have a tight project, like one that's an availability-based project, perhaps where you try to squeeze the DSCR to make it really, really low, and you squeeze everything in, then a really small risk can explode into a big risk. So these availability projects or the PPA projects, they might seem like they have no risk, but if we have the gearing up to 85% and the DSCR down to 1.1 or less than 1.1, a very little risk can become a big risk. Well, he was right about that. Some other projects have volume or traffic risk, and that's what we're going to talk about now. Some, like a real estate project or whatever, others might have both volume and traffic risk, okay? In the airport case, really the pricing might be driven by the government. Now, it can be, there can be, this is kind of interesting. It might be the case that you wouldn't really call an airport almost project finance, but everybody does because it's non-recourse debt. Other aspects of the area, they're not. It depends. There's less competition. There are barriers. People can't just build another airport in any way. I mean, they can build some, whatever. And they often operate under a cost recovery where you just have a cost plus. That's what we talked about in a couple of sessions ago. Okay, and then I just clicked on some. This is just general kind of crap. You go to Fitch and you can download all their little reports. They're pretty good to just to skim through. You know, they say here's the kind of volume risk you have. You can have cost overruns. You can have revenue risks depending on the contracts. Some of these revenues, you take a piece of the duty free, you know, so there can be all kind of things. And then they say good airports are ones that are in a whatever big city, and they're low. This BS, peak to trough. Sorry about saying peak to. So you look over a long period of time, and if the lowest compared to the highest is 5% reduction, then that's the peak to trough fancy. You use this more in corporate finance, so it does start feeling a whole lot about feeling, excuse me, a lot more like corporate finance. And there's equal business. Okay, this is again. And then here I've got this example of peak to trough real estate. Here, I don't, this must be the peak and the trough, and they go through the different kind of industries to try to gauge how volatile, in this case, the EBITDA margin is. And then they have moderate, and if you have moderate, you have a bigger peak to trough, and you have mid-size airlines, and you have some connecting stuff. And a weak one, that's good to talk about a weak one to understand high volatility, a whole lot of connecting traffic. I guess it would be a small airport with not many people, and if there's only one single carrier and then they go bankrupt, like I remember I used to talk to what's the airline I used to take that landed in Iceland, not Iceland Air, that what was I can't remember. Oh well, I spent the night in Iceland, and then here's what they have. This was pretty good. This is one of these risk matrices, and I always get a little intimidated by these risk matrices. They put the risk, and then they put the consequences. That's pretty good. And then they allocate it first between the state and the private company, and they put shared, and they put a little beautiful check mark, and then put some comments. That's pretty cool, isn't it? Currency exchange risk, and it's taken by both. Change it in the law. You wouldn't really want changes in the law to be taken by the private company, but it could, and so forth. Okay, and I have some other ones. This is the delay contract. Here's in this case, which was that? That was the private company takes the risk of the delay, the risk of a delay in operation due to whatever construction and subcontractors, and then after that you then reallocate the risk to the EPC contractors or the O&M contractors, or you keep it for the investors, and then you put the comments. So I thought this was a pretty good way to kind of lay out one of these risk matrices, and I haven't talked about them yet, and they should be discussed, and that's enough. So again, it's example. Here's an example of all the EPC costs. I better go through that fairly quickly. It's just how much you're spending on the terminal and how much you're spending on all the other stuff, the whatever the runways. That's not just other stuff, or the whatever the duty free shops and all that stuff. Okay. Then here's what I wanted to tell you. The big difference. I'm going to talk just a little bit about uh, uh, um, toll roads. Toll roads have been a disaster when they're not availability projects, when they don't get a fixed availability payment, when they get a traffic risk, when they have to take traffic risk, and that's because there's no history. of the toll road. You don't know what it's going to look like. And there's gigantic competition from the existing roads or even a new road. And you have to compute this value of time, and you have to figure out where people are coming from and where they're going from, and you don't have any history. For the airport, you often have history. And I've taken this kind of example, and here's an example of we have some history, and then we have some assumptions about how fares are going to go up and down, and you take that and you put some price elasticity to get your wonderful forecast. Okay, great. You hire some economists, to do that. And then, so what I did here is on this one, and I'm going to have to put this. Oh no. Uh-oh. And then I'm going to. Do I have an example of a traffic forecast? Okay, and if you look through this traffic forecast, I'm sure it's very good. They have all of these assumptions. Okay, and they put the passenger data in, and they have a graph at the end. That's the previous forecast. But here they had some history, and then they had a low scenario and a high scenario, and with after the history, they had some forecast. And what I suggest that you do is the history, the last date of the history was 2009. And they didn't have a graph that compares the history with the forecast. So up here, I suggest you take this, I'm going to use this date again. You take this date and you put a little true or false, and you say when this date is less than or equal to the last historic period, you just put this. Now, again, I told you over and over again, this whole thing is not about is not about making a bunch of Excel. But I think knowing how to very, very quickly make a graph and take one of these things, and suddenly you get a picture of it. And then I said, okay, we have, I did this totally like a complete stupid fool. Okay, because what I did here is we just make uh, we have a historic switch that I just made, so that wasn't that bad. And then we take the history and the forecast, and we just press F11, function F11, and then you can say, suddenly, do I really? I'm going to make a downside case. I don't know if I like this. Why are suddenly everybody going to come to this airport, especially kind of when it went down? Do you think they're going to take an airplane just only because there's a new airport? That might be the case, by the way. It might be the case that this new airport allows more, I don't know, big A380s to come into their runways or something like that. It might be the case that there's a good argument that the traffic will really increase, but I didn't see that. And then I think it was here. No, it was here. So now let's look at the low case and see what happened in the low case and show you a little bit how I did that. Okay, and it just, again, this idea, you don't have to be some Excel stupid thing like me, which is waste your life with all this crap. Instead, if you just know how to kind of take some of this data and make some quick graphs, and what I should have done is said, if it's the history, then we take the historic number, okay, and that just gives you a number. Now, if it's not the history, it just gives you a false. And if there's a false on the graph, it just doesn't show it. And for the forecast, we say if it's not the history, then we take the forecast and do it like that. Okay, and after we do that, uh, uh, I put this in the wrong place, almost like I did it on purpose. Not really. Uh, we put this right here. You've got to kind of put the X scale next to it, and all you've got to do is make sure the X scale has nothing on the top there. In this case, it wouldn't have even mattered, by the way. And then you press function and F11. And even in the low case, we have some increase. I'm a conservative old banker. I would like this low case kind of to look a little bit more like a low case. But that's the kind of thing you want to do, and that illustrates that for the airport, we really, uh, for the airport, we really should have looked at the history compared to the forecast. It's how valuable that history really is. Now, the other thing about the airport is, remember when we started all the way at the beginning, okay, and then I think I tried to have you do this. There's some contract language, the same kind of thing, and this is how you might finance the airport. But at the end of the day, the airport, they will give you, look at this, instead of, they said up here, leverage. They call it leverage. And what they mean by leverage is simply the debt to EBITDA. Debt to EBITDA, when you really think about it, if you're trying to explain debt to EBITDA to your mother, you'd say, look, if I have EBITDA coming to me, that's money that I'm getting. That's my salary minus all my expenses, okay, minus my utilities expenses, my rent expenses, everything else. It's my net salary, okay. And if my net salary, my income after I pay that, including I gotta go to the bars sometimes and everything else, that's my net amount that I get, EBITDA. And then if I have a loan, if my EBITDA is let's say 100, and I have a loan of 1,000, EBITDA for a year is 100, a loan of 1,000. I can take that EBITDA of 100 and pay off that loan in 10 years. And that's so in this case, if the EBITDA, if this is a really strong airport, it says that we can be a double A company by having a debt to EBITDA of 8 times. That seems to be long. And if it's a mid-range 4 times, and they give you this kind of criteria, now I gotta stop, because what I just said was one of the stupidest things ever. If the debt to EBITDA is 10 times, you still have to pay interest on that. You still have to pay capex. That you can never pay that debt off in 10 years. It's going to take a heck of a lot longer to pay it off. But of course, an airport lasts a lot longer than 10 years. So maybe that's how they get comfortable with these enormous debt to EBITDA ratios. Now you might think, why don't I use debt to EBITDA for a regular old regular old project financing? Well, if you think about a project finance, a regular old electricity plant or hospital or something else, oh, excuse me, that EBITDA is about constant. It might go up a little with inflation or something like that, but the debt is going down. So the debt to EBITDA will be skyrocketing. It's not supposed to be constant. But for an airport with a really long life and you have to make some capex, that's where it is. And so you can, in this case, there was also some other kind of ratios that you can compute a DSCR, and I've got some kind of little other examples here. But here's some just general. If we look at uh, uh, long-term debt, where's debt to EBITDA? Debt to EBITDA for other industries, it's God. If it was those levels that we showed for the airport, it would be just horrible. Okay, so I'm finishing this thing off now, maybe in a bad way. and I put some other definitions of ratios. This is how you'd look at different ratios for different kind of projects. Okay, remember for the airport, you just keep hopefully growing and growing and growing. So uh, uh, the EBITDA should be going up, hopefully, as you know. I know I don't want to get into anything else, but whatever environmental airport traffic probably will continue to go up. Okay, that's probably kind of going to happen. So the revenues would go up instead of being held constant. So the debt to, when we look at the EBITDA might go up, and then the repayment of the debt probably has a very steep increasing kind of a pattern, which I haven't shown, and that means that maybe, and you're going to refinance some of the debt. Some of the debt maybe doesn't even have a current repayment or has some kind of cash sweep in it. So that's why you might use debt to EBITDA rather than DSCR. All right, I think that's enough of this part, and whatever. I hope you turned the video off instead of giving me one of these thumbs down that makes my weak kind of vulnerabilities show. Goodbye.